Eric Wiegand. In your most recent piece, you say you are constructive on U.S. stocks in 2015. Well, how constructive are you?
You know, we continue to be constructive. Our view is that it's going to be an earnings-driven market, and you may certainly question, with earnings estimates coming down, how we can still have an expectations for growth. Our view is that we'll probably see about 5% earnings growth this year on a year-over-year basis. Add on a dividend yield of approaching 2%. So modest expectations. Our target is going to be around 2150 for the S&P 500.
Let's talk about the latest earnings period, Q4 earnings period. We got a lot of companies that got hit by the stronger dollar and they lowered their forecasts. How much of a headwind will this dollar be, even as we're getting job growth and some good economic numbers here in the U.S.?
You know, it's great, observation. There's no doubt about it. Whether you're looking at the healthcare, the pharmaceutical companies have been very vocal about the impact of the dollar on earnings. Energy, certainly, even technology companies have been very vocal about it. As we exited the third quarter of last year, consensus estimates for S&P earnings for the fourth were generally around 9% gain. The headwind from the dollar just during that brief period, the latter part of the fourth quarter, trimmed that number down to nearly 4%. And as we look prospectively going forward, estimates are still coming down in the 5 to 6% range.
How will the lower oil price offset the stronger dollar headwind? Which is stronger?
I think that the dollar's likely, stronger in the very near term, particularly with the number of the firms that have crude as a raw material cost. So much of it had been hedged going forward. You'd be thinking particularly of the airlines and other broad consumers. So dollar is having more of an impact, not only from the translation, the repatriation, but certainly, when you're manufacturing or your cost is dollar denominated and you're selling in non-dollar areas, they've experienced quite a headwind from that as well.
Do you think the consumer is really feeling the benefits of the lower dollar yet? We didn't really feel that in those fourth quarter earnings reports. So will we see it maybe in Q1 when actually people don't shop as much in Q1?
It's a great observation because it's been a great point of frustration for investors. Seeing all the benefit and not seeing a commensurate increase as far as retail sales are concerned. So it's certainly a question mark out there. What we are seeing, though, is that the consumer does have improved confidence. We're getting back to confidence levels that are really at what we had seen prior to the credit crisis. And you're also seeing them investing or spending more on durables. Things like auto sales. Housing is beginning to show some traction here as we move forward. Apparel and the likes that can be more discretionary, continue to be, on the softer side.
So we have a confident consumer, but will the Fed eventually sap that confidence by raising rates? What's your outlook for the Fed this year?
We do think that the Fed does raise rates.
June?
We are staying with June at this point in time. And a large part of that is, the renewed confidence that they'll have as a result of some of the strength that we're seeing coming through as far as wages. We saw an incredible number last week when we saw the payrolls. Not only did we see revisions up in the absolute number, but average hourly earnings certainly surprised by advancing at 0.5%. If we are able to see continued wage growth, I do think that the consumer will not be as concerned with the short-term transition at the Federal Reserve.
All right, give me a raise and I'll go shopping too. Thanks a lot.
Wonderful seeing you. Thank you.
And thank you for watching The Street.